Good afternoon. Thank you so much for having us. We are Team F, and today we'll be pitching Copart with a buy recommendation. Starting off with our agenda, I'll begin with a company and industry overview, then we'll be moving on to the investment thesis, then the catalyst and risks, and then I'll conclude with our valuation. On to the company overview. Founded in 1982, Copart is a global online auctioning vehicle platform. They take total loss, also damaged vehicles, primarily from insurance carriers. They handle everything starting from the towing, to storage, to title processing, as well as the auction. It was founded by Willis Johnson, and he has been operating as the chairman for about 40 years now, alongside their CEO, Jeff Leon, who currently has a background also in private equity and industrial operating. I mention this because I think it's important to note that Copart's leadership has been funded from institutional experience. Now, in terms of the business model, Copart's business model is extremely straightforward, but also equally effective and efficient. First, a car is totaled, then it is given to Copart. Copart then releases it as an auction to their global buyer base, and then from there, the best part about Copart is that they actually only take the transaction fee from their revenue, which makes up 85%. This is really great for Copart because they never actually own the vehicle itself, and then moving on from that they have no risk to their actual balance sheet, and leaving the remaining 15% of the revenue from just purchased vehicle revenue. Now, in terms of operating segments and geographies, Copart currently operates in 11 different countries, and since the post-COVID market boom, we've seen that revenue has stabilized, but the interesting signal is the international profitability. In the international markets, we've seen that the operating leverage has risen, which is a great sign showing us that early investments have matured, and also that international markets are soon going to be able to mirror the strong unit economics we see in the US.
Now, moving on to the industry overview. Copart is a global market leader in total loss salvage while also maintaining exposure in the wholesale vehicle remarketing and consumer and adjacent auto markets. Copart derives most of their revenue from total loss supply, which is where most of their revenue is from.
So Copart operates in the global vehicle auctions market, which has shown strong historical growth and is projected to continue to grow at a rate of 17.4% moving forward. So Copart controls 43% of this $10.5 billion industry, which derives most of its supply from the $1.3 trillion new vehicle market.
All right, so now moving on to some relative performance drivers and metrics. Copart has historically outperformed its peers, with its recent pullback being due to the increase in cyclicality of the insurance industry. We've also seen pullbacks within its peer group as well, those being due to the softening auto market and increase in the K-shaped economy. Consumers at the bottom of the K are facing macroeconomic headwinds, such as increase in pricing, tougher job environment, and stricter borrowing conditions, which has negatively shifted consumer sentiment, impacting the auto industry as a whole. Moving on to the competitive landscape, on the left we have the relative EBITDA and EBIT as percentages of revenue amongst Copart and its competitors. This is where Copart really shows its dominance. I also want to touch on Copart's multiple compression. Copart had a 2024 EBITDA margin of 41.4%, which has since then expanded to 42.1%. Meanwhile, Copart's EV to EBITDA multiple has compressed by nearly 50%, showing that this is not an issue with the business fundamentals. On the right, we have historical price to earnings and EV to EBITDA multiples. As you can see, Copart does tend to trade at a premium relative to some of its peers, which is justifiable, and it also avoids large multiple swings, which we think is a benefit.
Now, moving on to our investment thesis, it's backed on 4 main points: strong fundamentals, a durable business model, a discounted buying opportunity, and compounding power. Copart's 10-year relative performance compared to the S&P has been outstanding. They've grown double what the S&P has since 2016, all while maintaining steady growth with their 10-year CAGRs for operating cash flow and free cash flow, beating out the 10-year CAGR for revenue, which is signaling long-term stability with the cash flows for the company moving forward, all while maintaining zero debt and increasing their cash balance up to $5 billion, up from $1 billion in just 2021. This allows a variety of options for the company moving forward. They can purchase repurchase more shares, move into strategic acquisitions, or increase their capital expenditures. Right now, if you can see the PP&D breakdown, Copart is different from their competitors because they are able to operate on the land that they already own, which increases the barriers for entry for their competitors to be able to compete with them.
So next we'll go into some catalysts and risks. There are several industry tailwinds that continue to expand Copart's supply, pricing power, and long-term growth potential. So looking at the top of the screen, we can see an increase in total loss claims, and this is due to a few reasons, one of which being the increase in the cost of motor vehicle parts, which leads for more vehicles being deemed as total losses by insurers. This directly influences the volume of vehicles consigned to Copart. Now, on top of this, the stickiness of the cost of motor vehicle parts creates durability in economic downturns. So say in the event of a recession, the ACV, so the actual cash value of these vehicles decreases. And while the cost of motor vehicle parts stays high, it lowers the salvage threshold. Now, moving our attention to the bottom of the screen, we can see more miles driven, which increases accident frequency, and the average age of vehicles in the States continues to age, which goes back to more total loss claims because the average age of vehicles that are being deemed as total losses is above 7. So going on to some risks, Copart faces a few key risks in today's volatile environment, from cyclical swings in accident volumes, softer buyer demand, and heightened competitive pressures. However, Copart's scale, their deep insurer relationships, and their their global buyer network gives them flexibility and resilience to continue to grow even in tough market conditions.
All right, so moving on to our evaluation, we took a discounted cash flow model approach using both EBITDA X multiple and implied perpetuity growth methods to arrive at our implied share prices. We placed a 75% weighting on our EBITDA X multiple implied share price because we believe Copart deserves a market premium due to its size and the uniqueness of its business model. At the top of the screen, we have our model drivers, and on the right, we have our sensitivity tables. Moving on to our implied valuation ranges, we selected to use 52-week high-low and analyst price targets as sanity checks against our own analysis. We've included our perpetuity growth rate, or perpetuity growth implied share prices from our DCF, along with public competitor PE and EBITDA implied share price ranges as well. We do also want to note Copart is trading near its 52-week low, which we view as an attractive entry point. Moving on to our scenario analysis, we've included both bear and bull case scenarios, with even our bear case assumptions implying almost 9% upside using that EBITDA X multiple method due to the market premium we discussed, along with Copart's operating efficiency. On the other hand, we also see lots of upside with our bull case assumptions. Both of these scenarios are heavily reliant on the cyclicality in the insurance industry due to Copart's heavy dependence on the amount of total loss vehicles they receive to auction off. With that being said, although Copart is facing some short-term headwinds, we believe that structural advantages and long-term tailwinds present attractive upside, further enforcing our buy recommendation on the stock. And with that, we open up to questions. Thank you.
Why has it been such a bad stock whatever it peaked to where it is today?
Okay. So I think we saw, like Tori mentioned, with the post-COVID boom, it was trading at insane multiples, and the market was pricing in that growth very far into the future. And so we've kind of seen normalization in the amount, like the used car market prices, and then the actual amount of insurance claims. And so since the multiples are so stretched, I think even like their last 4 earnings reports, they've reported in line with revenue and bottom line, they've like just missed on top line on a couple of them, but I think the market took that and looked at it as a very negative impact because of how pricey and how high the multiples were. And then also it doesn't help that they've talked about in their earnings reports that like the cyclicality, like there's been an increase in the amount of under and uninsured motorists because car insurance, obviously their total loss pipeline, they do rely on a lot of the insurance companies to give those vehicles to auction. And so when economic conditions kind of tighten up, motorists are more likely to drop their car insurance. So that's in theory less of a pipeline for Copart to receive vehicles to auction. So I think the market's just been pricing in that.
What about the competitive landscape for other folks that do similar stuff like this?
I can take that. In terms of the competitive landscape, I wouldn't say there was much really to worry about. As we've kind of discussed in our presentation, one of the biggest advantages that Copart has comes down to the land, right? So their second biggest competitor was IAA, which was
Actual physical land?
Yeah.
Yes. So most recent competitor was IAA, which was also obtained by RBA Global, I believe. And the issue with that is even though RBA had acquired IAA, the difference is Copart owns over 20,000 acres of land, but they own 90% of that. Whereas RBA Global, which had just acquired IAA, owns about, I believe, 12,000 acres of land, but they only own 20 to 30% of it. So that's the biggest advantage, is that they actually own the land and they're not still paying all of those costs that their competitors are. And in terms of the market share, Copart is at about, I believe, 45%, whereas their second to third competitors are ranging from 10 to 15.
RB Global takes up a smaller portion of that market share, and it's just hard for them to catch up because of all the upfront costs with the IAA acquisition. Their margins have actually declined since they acquired them. Their revenue's grown, but their margins have significantly declined, so that's also another thing that I want to touch on. And also, I read something, Copart generates more on cash reserve interest that RB Global has to pay on their leasing for their land, so I also thought that was notable as well. Yeah.
So where's the total market size of whatever market this is? And Copart and the other public companies have what percentage? 5, 10, 90?
So I mentioned in the global vehicle auctions market, Copart owns 43% of this $10.5 billion industry.
Okay, thank you.
Roughly, there's estimates. It's kind of hard, yeah.
And the other public companies own the rest, or public companies and private companies own the rest?
I believe public and private, but none of them own more than a quarter of the shares, so no one's even close to Copart's share.
Oh.
Did you do a forecasted income statement? What were your growth and revenue assumptions? I mean, it looks like net income declined last year. Revenues were basically flat. What were you? Do you expect things to continue that way, or did you expect this to be the trough year?
So we do expect it to be the trough. We projected slightly, I think it was around 4 to 5% growth this year, which is under their 5-year CAGR of, I believe, 11% from their historical past 5 years. So we projected around 5% next year, but then we projected to pick up in 2027 and then kind of stabilize from there, because we believe there's still a lot of upside and room for Copart to recover. And like they mentioned in their earnings calls, they believe that this is a cyclical issue that self-corrects as long as macroeconomic conditions soften. And so we include that in with our forecast.
So how could you be wrong?
Well, we could be wrong if the macroeconomic conditions do stay kind of rough for longer than expected, like the next year and a half.
What parts of the macroeconomic condition?
Well, if we've seen, it doesn't help with the war in Iran right now, but interest rate environments, so there's actually the used car market right now. It's a very interesting, like, since they overproduced because of the COVID boom, these dealerships have these cars like from 2022, 2023, they're just sitting there. And so the prices were staying high, but since no one's buying them, they're marking it down. And so it's a really weird spot for the consumer right now in the car market. So I think just looking at historically, Copart does tend to, like, in cyclical downturns, they're more insulated to, like, versus like a CarMax or like an auto wholesaler to that consumer downturn. And so I think since they're more insulated, this is probably, we do project this is the worst it's going to get, and then everything's going to start to normalize. But of course we could be wrong. Who knows what could go on with inflation and the pressure on the bottom of the K, like we mentioned. So.
Also, the growing abundance of cash that Copart is building up since 2021 allows the company a variety of choices moving forward.
Did you say it was $5 billion?
Yeah. It is. It's a little bit over $5 billion.
And what's the market cap of the company?
30, I think it's around 33 billion, 32 billion.
And they have $5 billion in cash.
Yeah, they've grown it up from $1 billion to
very
2021.
interesting. Yeah.
And is there a risk that do they have set contracts with the insurance companies, and is there a risk that they could lose one of those contracts?
I would honestly highly doubt they would be losing those contracts, especially because of how well known they are, and they are the leading ones that companies know they could share it. And I believe it.
All right.
Thank you.
Well, thank you guys.